Personal finance practice problem using OneNote. Financial statement and budget, part 3, budget versus actual. Prepare to get financially fit by practicing personal finance. You're in OneNote. If you have access to OneNote, would like to follow along, we're in the icon on the left-hand side, the Practice Problems tab, down in the 2302 Financial Statement and Budget Part 3 Budget versus Actual tab. Also note, when using OneNote, take a look at the Immersive Reader tool. The practice problems will also be in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. Last time, we've been focusing in on creating our financial statements from the data on the left-hand side. That includes our balance sheet and income statement. Now we're going to use that information in order to look at our budget versus actual calculation from our data. So the balance sheet we created a couple presentations ago represents where we stand at a certain point in time. Assets minus liability, giving us that bottom line of the net worth, which if we were to explain in one number where we stand, could be the net worth. Then the income statement is going to show us kind of the difference or the story as to how we got to the net worth, taking us from our net worth last month to the net worth this month. Income statement on a cash basis, cash flow basis income statement looking like this, which we picked up from the information on the left-hand side, showing the income, the inflows, minus the outflows, noting that the inflows usually in categories are less than the outflows in terms of categories, but hopefully more in total dollar amounts as we focus in on one particular thing in order to generate money and pay for everything else we're going to need for our life, right? So everything else is going to be the expenses. Income minus the expenses is in essence then the net income. The performance statement, the income statement, is typically what we would use then to project into the future to think about what we're going to do in terms of an action system on the next setup. Now, note that this data on the left-hand side has been the actual data that we used to create the financial statements. Now we're going to look at the budgeting data, which we can imagine basically this is the data that we got from the prior year. We imagine that we put the budget in place last month, and now we're going to compare that budgeted number to the actual numbers that actually have happened this month. In other words, this income statement up top is the income statement which has actually passed compared to the budget which we put together prior in the prior period to see how closely we tied to our actual performance and what we thought would happen on the budget side of things. Clearly, the process would be just like any other type of thing. We're going to set the budget. We're going to set our goals. We're going to try to make them in such a way that they're attainable, but not way outside, and they're not too easy. Then we're going to try to go through our performance to whatever we're looking for from a budget standpoint to see if we obtain those goals. Then we're going to check whether or not we did reach the goals or how close we got. And then we'll make another budget and do the same process over and over and over again. It's going to be great. So in any case, we've got the information on the left-hand side. Also realize that when we're looking at the budget, we're looking at that income statement, we're looking at the performance numbers generally. We can think about the performance numbers and where it will get us in terms of the balance sheet. So in other words, if I'm thinking about a budget for the next month, I could think of at the end of that time period, at the end of the budget, where will I be in terms of balance sheet at the end of that process? Okay, so our budgeted information, we're going to be pulling from the data on the left-hand side. Notice we're just going to copy the same formatting here as we'd had in our income statement. And then we're going to have the same numbers for the actual numbers on this column. We're going to put the actual over here in the column to the right because we're going to put the budget first. The only difference then being that we're going to take this 3-column worksheet, scrunch it down into 1 column. I can use the same kind of indentations that we had over here to indicate that we have this indentations. This look a little bit easier of a form to look at due to the numbers being outside. Now we're going to squish it all into 1 column, but still have those subcategories so that it will be easier for us to do a side-by-side calculation without having a hugely wide report. So we got the 3,200, we got the savings that we put up top in this case, the 285, the 130 for the total savings of the 415. We had the fixed amounts of the rent, the credit card payments and the car insurance, totaling that up at the $795. And then we have the variable components being the $310 for the food, the shopping, the $320, the $620 for the auto entertainment, and so on. That added up for the total variable of the $1,920. Then we had the total cash outflow, which would be the total fixed outflow, the $795, and the variable $1,920 to give us that $3,130 for the total then being the net cash flow, which we're going to say the $3,200 up top minus the outflow of the $3,130. That gives us the $70. Notice we did vary the format a little bit in that we picked up these savings amounts and we put them up top, assuming in our budget, right? We put them up top in this category here, assuming that the saving amount is going to be a fixed amount. We're looking at, say, a cash flow kind of basis, that then getting us down to that same 70 that we see down below. We'll do the same process now for the budget side of things. So let's look at the budget. This is our budgeted numbers. We're just going to compile them into the same format. We would imagine that this happened before we actually ran the month, right? This should happen last month, and then the actual happened, and we can compare the two. So we took the $3,200. That's the net monthly pay. Then we have the savings. That's going to be the $285 that we're pulling in. The $285, which is here. The $130 for the other savings, totaling that up. That's going to give us the $415. Then we have the fixed outflow, which was the rent of the $420. We got the credit card of the $185 on the credit card payments, and then we have the car insurance of the $210. These three, when you're thinking about them from a budgeting standpoint, you would think would be fairly right on, because we're saying they're fixed, meaning they're not changing over time, and meaning, in essence, we don't have a lot of control over them with our short-term behavior to change the results. So the $420 plus the $185 and the $210 gives us the $815. We then have the variable components, which is going to be the food, the $290 on the food, the shopping. By the way, these are the ones that we would focus in on more, and these are because they're the ones we have control over. They're probably the ones that are more difficult to kind of budget as well, because these are the ones that we want to think about setting our goal to change behavior if we're trying to change behavior with regards to financial spending. So then we've got the utilities of the $595. Note that we added together the water, the cable, and the food to get to that utilities here. So we combined those three in this line item. That's going to be a decision factor choice as to whether you want to focus in on those line items or break them out possibly. And then we've got the auto, which is going to be the $240, which we put over here as gas and maintenance. And then the entertainment, we combined together the $185 and the $250 to get to, actually no, the $250 and the $211 to get to the $461. This is another area where we have a lot of control over our entertainment budget, and we may want to break out the entertainment into major categories that we like, spending money on. And then we could track those major categories individually and see whether or not, our reward versus the money spent, where do we want to spend our money and so on. So then if we add up the $290 and the $461, we get to the $461, we get the $1,771. Adding up then the total fixed cost and the variable costs, we get the $815 plus the $1,771 for the $3,001. And finally, the net cash outflow being the $3,200 up top minus that $3,001 gives us the $199. Now, the next thing I'm going to open up here is going to be the difference. That's going to be the most common kind of thing that we would look at, is just say, let's compare one to the other and see what the difference will be. So if we subtract these out, what we plan to happen on the budget side versus the actual side, looking at the difference, if we have a salary type of situation, you would expect the income to be the same from period to period. If, on the other hand, we work hourly, for example, or we have a sole proprietorship, then you could see there'd be maybe variance between our budget versus actual, and we'd have possibly more control in that situation in terms of how much we want to work compared to, other things we want to do. So here we got the same number, so there's no difference. The savings plan, if we plan to save and we got it like automatically set up, so these savings amounts are going to basically come out of our checking account automatically, which is probably the best way you want to do it oftentimes, so that you don't have to manually take the money out, so that it's a no-brainer, as they say. You don't have to think about it, and it's out of your checking account if you don't want to spend it, so that you could save easily. If that's the case, then you would expect the difference here also to be exactly the same, and we'd have no variance, no change. And then we've got the fixed. Also, the fixed costs would be things, because they're fixed by their nature, because we have no control over them, we expect them to be the same from month to month. You would expect these to be the same. Things like the rent, it is what it is. The rent's not going to change until we sign a new lease or something like that generally. And then the credit card payments, if we had decided to pay a certain amount for the minimum payment, it would remain the same. If not, of course, you might see some variance in the credit card payments. And then the car insurance, we're saying it's going to be the same payment from month to month. So once again, you would expect not to see much variance in these items, because we expect them to be relatively the same. Adding those up, we get to the 20. And then the variable costs, these are the ones that we expect to have more control over. So if we had the food, we've got the 290 minus the 310, that gives us a negative 20. Notice the actual is higher than the budgeted amount. That's usually bad for budgeting. So we overspent on the food category. And then we have the shopping, which once again we overspent. The budget minus the actual, it's a difference of 135. We spent more than we had planned to spend. And then we've got the utilities. Now note that the shopping is probably something, depending on what your shopping is. I'm imagining this is like personal shopping, like a personal kind of catch-all account for other stuff. That's when we have control over a lot. Food, if you're talking groceries, we might have a baseline control over, and then some flexibility above that line. And then utilities, you might think of as something that we have a baseline over as well, and then some control over that baseline. So you would expect some variance that you might have some influence by behavior over. And you would expect possibly utilities to change, especially the electric, from seasonal changes as well, if you're in an area where it's overly hot or overly cold. And then we've got the auto expense. This is something that you would think that you might have a baseline for if you drive to work, for example. And then the over and above for entertainment purposes might have more control over. And then entertainment, obvious something you'd have a lot of control over. The 461 minus the 350 gives us a 111 surplus instead of a deficit in that case. So if we add these up, notice you can add these up a couple different ways just to work on your table calculation. It's useful to be able to kind of verify your numbers. So you could add them up this way. You could say, okay, this is going to be the 20 plus the 135 plus 25 plus the 80 minus the 111. It's going to give us that 149. Or you could say, let's do it this way. Let's take the 1771 minus 1920. You get the 149 again. And then you can take the total outflows, which you can add up as the differences, here being the 20 minus the 149. That's going to give us the 129, or the change this way horizontally, which would be the 3001 minus the 3130, the 129. And then finally, you get the bottom line number, which would be the 0 minus the 129 here, or you could take the 199 minus the 70 to give you your double verification on it. Now, it's also common to kind of compare everything to the income line item, and sometimes this is easier to see. Sometimes it's useful to be able to compare this a little bit more easily to prior periods and to other people that are helping you out with a budget. You can compare your budget to other people that have different earnings by comparing your percent to income. So obviously, the 3,200 divided by 3,200 would be 100%. If I compare everything else to income, and this is usually what we think of, and I mean, if it's on a business side of things, you would think of as the income as the objective. So you're kind of comparing everything to the objective because you have a profit motive for business. You still kind of have a profit motive here, but it might not be the exact same. But you've got your income and you're comparing your expenses to your income. So how large on a percentage basis are your expenses in relation to the income? So if we look at the savings, for example, we've just taken the 285 divided by the 3200, and we get the, moving the decimal 2 places over, the 8.29%. So we got 8.91%. 8.91%. of our earnings is going to savings. And then we got the other savings, which is going to be 130 over the 3200, moving the decimal 2 places over. We got the 4.06 about. And then total savings you can calculate by either taking the 415 divided by the 3200, giving us the 12. If we move the decimal place 2 places over, 12.97. Or you could be adding up the 8.91 plus 4.06. And that would be the 12.97 as well. And you can continue this on down. Let's do one more category. You've got the 420 divided by the 3200, moving the decimal over 13.13. We then got the 185 divided by the 3200, giving us about the 5.78. And then we finally have the 210 divided by the 3200, giving us about 6.59. Totaling that up, we could do two ways. 818 divided by the 3200, that's going to give us the 25.47, or we could take the 13.13 plus 5.78 plus 6.56 about, giving us about 25.47. And we can continue that on down and look at how much we're spending on a percentage basis. And like I say, this is useful when you're comparing periods to periods, where income is going to be different from periods to periods. And if you're comparing to other people who have different income levels, higher or lower than you, you could say, well, how much are they spending on average, for the rent or something like that as well. And then we can do that comparison, same kind of thing on the actual side of things, taking the 415 in this case divided by the 3002, getting the same number. The differences are going to start happening down here where we have these variances, the 310 divided by the 3200 at the 9.69 compared to the 9.06. And sometimes that's a little bit easier to see, kind of more drastic changes or changes that you might have then want to consider. Clearly then you're looking for anything that would be outside a range. You might actually set a range and whatnot and say, well, anything outside a particular range is a change that I want to look into more and see why it is exactly that I spent more than I had budgeted to spend, and then make the appropriate adjustments next time for the next budget, so you can then change your behavior or do whatever you want to do, set in the goals you want to set, meet those goals, and then set more goals, and then do another budget, and then meet those goals.